But what happens? The herd, after making the profit, leaves, but you remain stuck in that category only. You have bought the share at one price at one point of time, but you forget to sell. And what happens ultimately? The shares are sold by the herd and the price have fallen tremendously. And what you can do? You cannot do anything. The price has always already fallen and you cannot sell it. The herd is out, but you are stuck in the loss-making proposition. The another don't is don't sign blank delivery instructions. It sometimes happens that your broker or sub broker advises you to keep your signed delivery instructions blank, without date, without the name of the script, without any instruction except your signature in his drawer or in his locker, and he says he will execute and inform you. He can execute any number of transactions because more or less you might have issued him instructions, you might have issued a letter to him, or you might have issued him a power of attorney also, and he may misutilize it, and the delivery instruction slips that you have handed over to him by signing your own signature, but those which are blank, and you should not give them. So don't sign blank delivery instruction slips and keep them with broker or DP. So tell your DP or tell your broker that whenever there is a transaction, you are readily available. You are readily available with your delivery slips, and you are readily available to sign those delivery slips and hand it over to him in no time. But in no case you should not keep your signed blank delivery instruction slips with the DP or stockbroker. Another type of investment that an investor can do, which is very safe also, it has more return sometimes than equity markets, is mutual funds. We always hear while investing in mutual funds that investments in mutual funds is subject to market risks. So when we are investing in mutual funds, which is also one of my favorite mode of investment, you read the offer document before investing. And I assume that not many investors read the offer document before investing. We simply follow certain procedures, certain practices, and start investing in mutual fund because some of our friends, some of our colleagues, some of our relatives are always doing it and earning good profit. But the first do's is always read the offer document before investing. It doesn't take much time to read the offer document. Investment in mutual funds can be risky, but it is not as risky as the primary or the secondary market of equity shares, and do not necessarily result in gains. This is also true. Some advisors suggest that investment in mutual funds is always profitable, and unlike equity shares, you do not make losses in it. But I can suggest from my own experience that investments in mutual funds is equally risky and do not always result in gains. There could be losses in one particular sector in which mutual fund might have invested, but more or less investment funds are better than equities. Another do's of mutual funds is very simple to understand. There is an old saying, do not put all your eggs in one basket. Similarly, do not put all your mutual funds in one basket. Diversify your investments. Diversification is important to balance the risk involved in investment in mutual funds. Diversify your mutual funds in different type of mutual funds. For example, some mutual fund might be investing in large cap equities, some mutual fund might be concentrating on mid caps, some might be concentrating on small caps, some might be concentrating on digital companies, some might be investing in blue chip companies, some must be concentrating in pharma companies. So whenever as an investor I'm investing, I should not put all my eggs in one basket. I should divide it. I should balance my fund by investing in number of mutual funds, 1, 2, 3, 4, 5, the ones I can manage. I will invest in mutual funds, but I will diverse my portfolio of mutual fund itself just to balance and reduce the risk involved in the one particular mutual fund. Another do's of investment in mutual funds is past performance of a scheme, that is past performance of a particular mutual fund in which it was investing. is never indicative of the fund's future performance. For example, a fund did really, really well in past 3 years, but due to the change in fund manager or change in the team of fund manager or change in the incumbent, there is a new fund manager who is not as experienced as its previous incumbent was or not as aggressive as its previous incumbent was, might make certain decisions that tremendously reduce the value or tremendously gives a setback in the NAV of the mutual funds. So what would happen? The prices of the NAV will fall down, and your investment, which I was understanding is the depending on the past year's performance, falls significantly in the current year. So the past performance of any scheme or any mutual fund is never indicative of the fund's future performance. What I have to do is I have to simply make certain changes in my daily schedule. I have to keep regular track of the NAV or the funds in which I have invested. So if a sector is performing well and my NAV is going down, I should be cautious enough to know that what is happening to my fund and what is happening to the similar funds in which I have not invested. Why my NAV is going down while the whole sector is performing well, whole other mutual funds are also performing well, but my NAV is reducing. So I have to keep a regular check. If not daily basis, it could be done weekly, it could be done fortnightly, it could be done monthly. But it should not be the case that once I invest in mutual funds, I should forget it. I should never forget, because it is my hard-earned money which I have invested with some objective for some time period, a fixed time period, in anticipation of earning good amount of returns in the shape of dividend. So I should always keep a track on the NAVs of the mutual fund that I have invested. And in case there is a loss, continuing loss, then I should also consider to come out of that particular scheme, or I should switch in other scheme of the same mutual fund. Another do's of mutual fund investing is invest in a scheme depending upon investment objective and risk appetite. As I said earlier, whatever is my investment is with some objective. Primary objective is to earn money by way of dividend and returns, and some time period, that for how much time I want to stay invested in that particular scheme. 1 year, 2 year, 3 year, 4 year. The time period has to be decided, that objective has to be decided, and my risk appetite has to be decided. If I cannot have any amount of loss or negative appreciation in my investment, which is always there in equity and mutual funds, I should not invest in mutual funds. Then rather I should go in fixed income schemes. Then the very important aspect is always declare a nominee in your investments. What I mean to say is here is that whenever I make an investment, I should always nominate my demat account. So in case of any eventuality of my death, my legal heirs, my nominees can claim the investment value. Another important don'ts of mutual fund market is don't deal with any agent, broker who is not registered with AMFI, that is Association of Mutual Funds of India. Don't get carried away by the name of the scheme of mutual fund. It may be possible that one fund name with one company, the mutual fund is doing very well, and I invest in another scheme of which I am not even aware of. But because the mutual fund is new and the company is a well-established company with good goodwill, I invest my money in it. It is not the case that investment in that mutual fund would always give me good results. So I must not get carried away by the name of the scheme or mutual fund. I should not invest in schemes because of commission or other incentive which some middleman or some sub-broker might offer me. Don't forget to take note of the risk involved in the investment. With every investment, it is same, that I should not take note of the risk. Don't fall prey to promises of unrealistic returns or guaranteed returns. In any investment, there is no guaranteed returns except in fixed income or fixed return investments. So if somebody is offering me that this amount of the percentage, I would be definitely short. I should make investment. This is not the case. This is not a good investment. This is not a good advice. Just like bank fixed deposits, we have got public deposits. So public deposits always bring some amount of fixed percentage of interest, and I must do certain research work before investing in public deposits. I should do proper research on the financial health of the company, which is very important, such as deposit book, its size, the repayment track, the defaulters statements or the defaulting history, the interest payment, the compliances. For example, the company might be paying you interest, but it has deducted the tax and has not deposited the same with the income tax department. Check the credit rating of the company in which you are making the investment. It should be at least AAA, or it should be at least AA, and in otherwise it should be at least AAA. Check for penalties for premature withdrawal of deposit. This could be a case where the premature deposits are not permissible, and in case one investor is trying to make a premature deposit, certain penalties or certain fees is involved. So you have to also see that kind of clause, that if you are in need of money, say after some time, and you want to make a premature deposit, then what is the premature penalty or fees that the company would be charging you. Read the instructions for making application for investing in public deposit. Declare nominee to your deposit. As I said in the mutual funds also, in every deposit that you make, always mention the name of a legal nominee that you want the money to be given in case some eventuality of your death is there. Proceed for legal action with SEBI, RBI and other associated regulators, and even the company in case default is there and investor is feeling cheated or feeling aggrieved by the actions of the company in which it has made the deposits. This is very important because there could be certain investors who don't deposit, who don't make investment through equities in primary or secondary market or even in mutual funds, but they find public deposits or some other kind of deposits very lucrative. So apart from the do's, there are certain important do's which should always be considered before making investment in deposits. Do not get attracted towards higher interest rates. One has to consider that the rate of interest in FD, PPF, RBI, etc. is X. So if some company is offering you thrice that percentage or 4 times that percentage, that company is not going to commit. Don't get attracted towards higher interest rate. Interest rate has to be reasonable. Higher the interest rate, higher the chances or risk involved towards that investment. Do not invest in a scheme of deposit where the credit rating is poorly rated or unrated. Do not fall prey to promises of unrealistic returns or guaranteed returns. Don't blindly follow the advice of brokers, because brokers always get a commission out of the amount that they bring to the company. So brokers are always determined to bring more and more pool to the investor, but it could be the case that the brokers are giving hefty amount of incentives. The incentive is always coming from the amount of your investment. So in case you are offered a very high amount of investment, which even government bonds, PPF, FDs, saving bank account is not offering, then that investment could be risky, and it may be the case that the company may run away from at one time, and you are left with no option but a piece of paper. Do not forget to take account of the potential risks that are involved in the investment. Rule holds good for every kind of investment. Do not hesitate to approach the proper authorities for redressal of your doubts and grievances. As I said, in any investment that you have made and you feel that there are certain grievances, one should not hesitate in approaching the proper authorities for redressal of their grievances, doubts or even complaints. Buyback of securities. This holds good when I have certain securities in my hand. Otherwise, I cannot give back my buyback securities in buyback. So, when a company is coming out with the offer of buyback, I should read the special resolution regarding the proposed buyback and then only vote for it. Maybe it could be a chance that I do not wish to sell the shares. Still, I voted in assent. So, this proposed resolution should be read, and only after I understand that resolution fully, I should vote against or I should vote in favor of that. Compare the price offered in the buyback with the market price along with the EPS and book value. So as an investor, I must make a thorough check whether I really want to encash my securities by surrendering them in the buyback procedure, or I want to retain it. For that, you can check the price in the market, the offer price that the company is giving, the EPS and the value of the share. Read the instructions. It is a do. For making application for tendering of shares carefully. Tender shares for buyback within the offer period. If it is offered after that, there is no value. Furnish all documents asked in the offer letter. Send application through the mode specified in the offer letter. And another do is contact compliance officer of the company or the any grievance. Then there are certain don'ts which are attached to the buyback of the securities. Don't submit multiple applications for tendering shares in buyback. Do not make your decision based on media reviews about the buyback. Have your own assessment of the proposal of buyback that you have received. Avoid overwriting in the application form, and in case you have made overwriting, do initialize it and do put your signatures there. Fill the application form legibly. Don't give wrong contradictory information in the application form. Do not give any wrong information in the application form. Do not send application after closure of the offer. Then there are collective investment schemes which companies float for attracting investments in those schemes. So when an investor wishes to not invest in equity, mutual funds or secondary market or deposits, then collective investment schemes are good for them. They must ensure that the entity is registered with SEBI. You have to read the offer documents, objects and appraisal of documents carefully. Check the credit rating of the scheme and tenure of the rating. Check the viability of the project in which your money is going to be invested. Also verify the background expertise of the promoters as well as the corporate entity also. Ensure that the Collective Investment Management Committee, that is CIMC, has the necessary infrastructure to carry out the activities of the scheme that is written in the offer documents. Ensure that Collective Investment Management Company, CIMC, furnishes you the copy of the balance sheet and the annual report within 2 months from the closure of the each financial year. Then there are certain don'ts attached with CIM investments also. Don't invest in CIS entity which is not registered with SEBI. Do not invest your money based on market rumors. This holds good for every kind of investment, let it be equity, mutual funds, deposits and collective investments or advertisements. Advertisements could be luring, advertisements could be misleading. So you have to use your own brain to assess whether you want to invest in these schemes. Do not fall prey to promises of unrealistic return. As I said in the case of FDs and deposits also, there cannot be any unrealistic return. A return has to be reasonable because any company that is giving you returns has to first deduct its own expenses and it cannot earn huge amount of income without any sound proposition. So unrealistic returns are fake. You have not to rely on them. Guaranteed returns are also not there, that they will be giving you 60% return, 50% return, or they would be doubling your money in 1 year. It is not the case. 100% return is not there. 50% return is not there. Do not take note of risk involved. Do not forget to take note of the risk involved in the investment. And also don't carried away by indicative returns. Indicative returns are deceptive. Do not fall prey to the indicative returns. Another aspect is when we are dealing with a stockbroker and sub-brokers. There could be certain brokers or stockbrokers who claim to be stockbrokers, SEBI registered stockbrokers, but they are not. So you have to always deal with only SEBI registered stockbrokers and you have to ensure that you see their SEBI registration certificate and its expiry also, that they are, when you are dealing with them, they are actually registered as SEBI registered stockbrokers and sub-brokers. Ensure that the sub-broker is permitted to transact in the market. Enter into an agreement with your sub-broker or broker setting out the terms and conditions clearly. Ensure you have read what you are signing. There is a gap in the fine words or the agreement, so you have to read each and everything. Don't sign your agreement blindly. Keep track of your portfolio in your demat account on regular basis. As I said, demat account reflects your both investments in equity as well in mutual funds. You have to keep a track on it. You have to keep checking your demat account every now and then after say 7 days, 15 days. You have to declare, you can declare and you have to declare your name of the nominee in your demat account. While dealing with your sub broker or stock broker, there are certain don'ts also. So don't deal with unregistered brokers, sub brokers, or other unregistered intermediaries which might be functioning in the area. But you have to ensure that the dealer, the broker, the sub broker that you are dealing with is registered with SEBI. Do not pay more than the approved brokerage to the intermediary. The intermediary must be charging some amount of fees on the services that he is giving to you. So you have to pay the fees through banking modes, and you have to see that you are not paying over and above what has been agreed upon in your agreement. Do not execute any document with any intermediary without fully understanding its term and conditions. In case you do not understand the terms and conditions, seek the help of some professional or some of the person who has actual in-depth knowledge of those terms and conditions, and only after you understand those terms and conditions, then only you should go forward to sign those documents. Do not carried away by luring advertisements. As I earlier said, there could be deceptive, misleading or luring advertisements. Do not get carried away at all by those advertisements offering you a unrealistic rate of return on your investments. Do not sign blank delivery instructions while meeting security paying obligations. With these words, I end this presentation. Thank you.